This podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
I only just got this stock picked recently. I'm annoyed that we're giving this away because I actually only just got in this stock and I'm all excited about it and I wasn't going to tell anyone about it. And Ben's whacked it in as the bonus pick, so I'm pretty pissed off about that, to be honest. Anyway,
so this is valuable alpha generation for early podcast subscribers.
Hello, welcome to another episode of Wealth and Toil. My name is Luke Laretive, and I'm here as per usual with the Tasmanian Prince himself, Dylan Pargiter-Green.
One day you will get that right the first time.
One day I will not.
G'day everyone.
How's your week been, mate?
Really good, mate. Really good. We were treated to a classic Tasmanian public holiday on the Monday, which just happened to coincide with Super Bowl day. Big NFL fan, not of either of the teams that were in it, but good to see Taylor Swift get a win.
I've never seen my partner Claire be more interested in a game of sport in my entire life. She's quite a phenomenon, the old T Swift. And good luck to her. She's making squillions. We have a guest, our first guest on the podcast.
And what a guest.
He's only come on because I actually pay his wages every month. So that's the only way we've been able to actually secure a guest to join us at this, relatively early juncture in this relatively average podcast. Is young Benjamin Richards, who is an analyst at Seneca Financial Solutions, and he helps me run all the portfolios really and cover stocks for us. Benny, thank you very much for your time today.
Thanks for having me on, gents. Good to be here against my will or otherwise.
Mate, I am very much looking forward to hearing about what you have to say, Ben. It is always a pleasure.
We are going to skip the usual market wrap because we're actually going to talk about markets all day today. It is February 15th on the day we're recording this, and 2:30 in the afternoon, and it's reporting season on the ASX. So we've got a range of stuff to talk about. Benny's going to go through some stocks. We're going to talk a little bit about how they might fit into your portfolio, or how you can think about that in a bit more of a broader sense, and how Dylan and I are kind of I suppose advising our clients and trying to move forward. So Benny, I thought we might start with a sort of theme that we're running at Seneca at the moment, and that is the property sector, and we're looking at sort of 5 or 6 different ways we're kind of getting exposed to property, whether that be through direct real estate trusts, whether that be through technology players that are leveraging off the sector, or lending and the financial services part of the property sector. But before we get into that, Dill, do you want to just maybe talk a little bit about people saving for a house? People who have the goal of buying a house, upgrading their house, being involved in the property ladder, which I hate that word, but I've just used it. But being involved in the owning a property of some description. Talk about maybe how they can do that with smaller sums of money and maybe get started with some exposure to property rather than just saving in cash.
Yeah, so a really great way to save for your property and is, you don't have to start with thousands and thousands of dollars, but it's investing to do it. So investing along a journey so that you can build up enough to get that first deposit, whether that be for your own home or an investment property, but people often come to us and say, oh, well, property is such a big part of the Australian market, but I can't get in there because I don't have this big deposit, or I can't get into the properties that I want to get into. The reality is here with what we're going to talk about today is that there are a lot of ways to get exposure to that industry and that area of the market without physically holding a secure asset. Now, that's not to say that physical property is not a goal that everyone should aspire to. If that's what you want, then fantastic. Some people prefer to just have liquid assets and build towards that. But being exposed to property as a sector because you like the fact that property has a physical asset behind it, you like the fact that the property has the compounding effect of leverage built in some cases, this is a way to get that exposure to that industry and that sector without necessarily having, to fork out a couple of $100,000 as a deposit and pay stamp duty and then have an asset that's relatively illiquid.
And also from an investment perspective, you don't have any tenant. You can get the rental income without having the tenants to manage. You can get the asset value appreciation without actually having to hold and manage the asset, which, some of the physical costs, some of the practical costs associated with owning physical real assets, you obviously don't have those via these vehicles. So there's not all upside. There are other things that make physical property more attractive than investing in the markets, but there are certainly things that are worth considering, particularly for those retirees or people in the latter stages of life who are de-gearing or no longer going to be utilizing someone else's money to buy an asset. So Benny, without further ado, why don't you kick us off with a real estate investment trust that you and I have identified as really high quality and pretty undervalued?
Yeah, so I guess in the REIT sector, more broadly, you've got a whole range of things that aren't just residential property. You've got industrial, office, retail, convenience, all these kind of things, which is not easy to get exposed to as someone with a smaller amount of money or just a broader share portfolio. So I brought to the table today 3 of our REITs that we own in our Seneca Australian Shares SMA.
As we get into this, Benny, for people that don't know what a REIT is, Real Estate Investment Trust, one of Luke's bloody anagrams that we always harp on about.
We might make an acronym list and then include that with the show notes.
Too much jargon already.
Build on the jargon over time. That could be.
But can you do a really high level explanation of what a real estate investment trust or REIT is?
Yeah, so a real estate investment trust is just a unit trust which owns a property, which the investor is entitled to the distributions that come from rental yields from those properties. So it's an attractive sector for typically income focused investors, but can be growth as well. Which of our top 3 picks, to lead us off, the first one is Goodman Group. Ticker is GMG. It's a big monster of a real estate investment trust. Market cap over 50 billion. Led by founder Greg Goodman. Owns about 4% or so of the stock.
And Benny, why do we like founder-led businesses?
Well, it means they're aligned for one reason. So they're incentivized to grow the business and to grow dividends to shareholders because that's what they're going to get paid at the end of the day, more so than just their salaries that they'll earn from keeping the company afloat.
I'd like to add to that as well. If Dylan's a founder-led business, I'm a founder-led business, and I reckon
Ben's a founder-led person.
Ben's a founder-led employee, and or as I like to call him, the cost center, and yeah, he's a poor bloke. He has to work for me. So, but I'm serious. I think that there is an emotional attachment to your business, and it makes you go to extraordinary lengths to succeed. And I think anyone who owns a business can kind of appreciate that. And so you'll hear, me and Dylan and Benny and probably every other guest we have on talk about the benefits and the potential for outperformance by investing alongside founders and people who are business owners. And it's just something that we fundamentally at Seneca anyway believe really heavily in. So Benny, sorry, I cut you off. Goodman Group, keep going, mate.
No, you're right. And yeah, they've got a great track record. They do industrial property. So they're one of the leaders globally. So what's an industrial property? Well, I mean, people tend to think of them as sheds, big sheds, but they're kind of things like warehouses, data
Think like
centers.
think like industrial park. That's
Yeah.
kind of the easiest thing to do. If you drive past
Concrete boxes.
concrete boxes with a bunch
Yep.
of fancy stuff in them.
Absolutely. You got an
Um,
online business, Goodman Group probably owns your shed.
Yep.
Correct.
So look, they went bananas in COVID when e-commerce was booming, and warehouses are hot in demand. So yeah, I mean, in general, they've got a really good track record of growing earnings per share over time.
And that's really been aligned with that e-commerce kind of winning market share of total retail on a global basis.
Yeah, and they've delivered an earnings beat, so they've beaten expectations of the analyst community out there in 11 of the last 12 half-year reporting periods.
That's good going.
It's pretty good going, considering the market's it's reasonably efficient, so they should be the estimates should be in the ballpark.
In a $50 billion market cap, you'd hope so.
Yeah, pretty well covered. And in fact, they've just reported today as we're recording this, and I think shares have popped
up 6%. Profits, distributions, pretty much everything above analyst expectations, consensus. In fact, like above top end in some instances, top end of estimates, that is. So very really high quality result. I haven't been through it in a heap of detail just yet, but looks red hot.
Boys, what do you reckon the threats or the defensive part of Goodman is when you think about mega companies like Amazon really entering that space and owning that space, particularly throughout the US? Is that threat to Australia with someone like Goodman who's already pretty established and runs a very, very smooth operation?
Yeah, I mean, it's definitely not an industry with a heap of barriers to entry. Having said that, though, I think what Goodman Group has done really well is they've established a lot of the near highway locations. So they've kind of secured a lot of the good areas that the large tenants want to be in.
Amazon's a customer of theirs. So, they're often Amazon are actual tenants, and they're paying to fit out these warehouses with their robotic logistics systems and stuff like that. And as a result, they're actually adding value to the Goodman Group properties.
Right.
And those kind of tenants obviously sign long, competitive leases, and Goodman then eventually flip those properties to secondary market investors and make that capital gain. So
yeah,
I think,
or sell them to Amazon themselves, right?
I think Amazon want to take their capital, and they want to, Amazon or any of these high tech businesses, they want to take their capital and reinvest it in the technology part of their business where they get the highest returns. They're not property investors. They don't want to own property. It's just a way to tie up a lot of capital that it gets a relatively modest rate of return on. So they don't want to be property owners. They don't want to be property managers. They want to be tenants and put their shit hot businesses inside those boxes. I want to know, all right, stocks trading at Goodman Group trading at 28.40 at the moment, up 6.8% on the result today. Those numbers to one side, let's pretend it's yesterday and the price isn't up 6%. What's been the valuation for Goodman? How are you going to price this thing, and what kind of dividend yield can I expect from the company, or how am I going to make some money out of it?
Yeah, so on an earnings basis, I suppose it looks relatively expensive compared to the rest of the sector.
Why is that?
I think it just comes back to that track record of delivering earnings growth and surprises to the upside, which, again, coming back to the founder-led, like if you can, manage it 5 to 10% better than the competition, you've got the best assets, you tend to sort of deliver long-term compounding of earnings over time.
Yeah.
Shares trade on about mid-20s PE. It was about 24 times forward earnings when I checked yesterday. And yeah, this year looks like it's going to be a pretty good one, so that might shrink that price to earnings multiple a little bit as the earnings comes up. And on a book value basis, again, it is at a premium to peers. It's just over 2 times price to book value. So that's kind of what the value of their properties are on an accounting basis.
So why would an investor pay? I mean, we're going to get to a couple of more value-based opportunities in a minute, but why would an investor pay 2 times the book value of an asset for those assets?
Because I suppose you've got to pay some sort of premium for the management to deliver further growth. Like if you're priced on 1 times price to book value, you could roughly liquidate those assets and pay you back your capital, but no more than that. So yeah, there's got to be some sort of optionality ascribed to that, quality of track record.
And that quality of track record in the instance of Goodman Group is really about managing reinvestment. One of the big things about property is you own an asset, it depreciates over time, the building itself, and you might make some money on the land or whatever, but net the building's going down in value, and as a result, that they can then sell those assets, and you get this big chunk of change at the end. But you've got to know what to do with it, and you've got to go and build another asset that's going to generate you a similar or ideally a better return over that lifetime. So Goodman have proven to be able to consistently reinvest at higher and higher rates of return off what has been a pretty impressive sort of track record with their ability to develop these buildings and then lease them and then eventually flip them and over and over and over again. So that's really.
I think the fact they've been able to do that as well over the last 18 months whilst rates have been rising just speaks to their quality of business, right?
Very high quality business. Very high quality business.
Yeah.
Arguably right up there, like top 5 quality business on the ASX, in my view. All right, Benny, let's go stock number 2. What's on the list?
Second, we've got Charter Hall.
One of my favourites.
One of your favourites, Luke. I might need you to talk a bit about that one as well. But yeah, I mean, it's kind of one of these diversified ones that owns a bit of everything in terms of office, retail, industrial, and they've also got a funds management business. So, people might be familiar with some of their real estate investment trusts that are actually listed separately to the head Charter Hall company.
And just to be clear, we're talking about investing in the management company, not in the underlying trusts.
The management company. So the management company generates fees off those other REITs. If DPG will permit me to use the jargon.
Yep. Granted.
Approved.
Granted. So yeah, you can get exposure to a variety of REITs through Charter Hall. And yeah, in general, we kind of see it as the best of the more highly geared ones. So Goodman Group kind of is low on the gearing range relative to the sector. They kind of had a bit of a blow up during the GFC just by getting too geared, and they kind of learnt their lesson now, and they're not very geared. Whereas Charter Hall has a bit more gearing,
a bit more aggressive.
Having said that, we don't think it's super risky. Like at the head company level, there's minimal debt. But yeah, Charter Hall, look, it's a bit more affordably priced for the value savvy investor. It's traditionally kind of traded on about a market multiple of 15 times price to earnings. And yeah, it's got a great track record of, again, growing the dividend. So just coming back to Luke's point on the reinvestment rate, where Goodman pays out a lower dividend, so it's probably less than 2%, Charter Hall probably has a higher payout ratio where they think there's not as much reinvestment opportunities. So that the shares yield about 3.5% or so. And yeah, Luke, anything you see with Charter Hall that you want to jump in with?
No, go on, Dill.
What about talking about the sort of price sensitivity with the interest rates? So Charter Hall historically very sensitive, or very correlated, it's a better word, with the sort of long-term interest rate movements. And consensus would be that we'd be at or near peak interest rates now, so peak bond rates. Share price was pretty high in 2021. It's pretty low by comparison now. So, that follows pretty well the first RBA hike and probably the most recent couple of holds.
Right, this is core to our thesis, and the reason why we're investing and overweight this sector in general. And we think there's significant opportunity for alpha, not just from buying businesses that can generate essentially more profits this year than they did last year, and so on and so forth, but a valuation tailwind. The whole REIT sector is essentially a play on what we would call, and you can put this in the jargon list, long duration assets, and long duration assets.
LDAs, you reckon?
They're not called LDAs, but we'll just essentially assets that have you pay a lot up front for, and they last a long time, i.e. a property, and or a gas pipeline or a power station, or there's lots of examples of long duration assets. But long duration assets are capex up front, regular cash flow over the life of the asset. So therefore, when you value those assets by changing the risk-free rate, when you do your discounted cash flow valuation, if you dial that rate up, the actual value of those future cash flows goes down quite significantly. If you dial the rate down, which is exactly what's happening now, we're seeing interest rates peaking, maybe be up a little bit more, maybe go down a little bit more, but on the whole, trending down. Bond market is pricing those expectations of future interest rate declines, and we've seen the Aussie 10-year bond fall from 5 to 4%, as we've talked about last week, and as a result, the discount rate that we're using to discount those cash flows over time for these real estate investment trusts is actually going down, which means the valuation is actually going up. So we think that those assets can benefit from declining, in real estate terms, capitalization rates, but that's just a fancy word for saying the discount rate, the interest rates, and as a result, we're looking to buy really good quality assets at what we feel are cyclical lows in valuation, and that are still yielding really good returns for us. Whether they're being reinvested or paid out to us, we're not so concerned, but that is the core thesis of what we're talking about today. Specifically on Charter Hall, I really like it. It's got good assets. So all of these companies we're going to talk about, Goodman Group, fantastic industrial assets. Charter Hall, a more diversified suite of, retail, shopping centre, commercial, industrial, whole kind of kit, mixed bag there. But again, really high quality assets, really well located, focused on the, core population centres, and the things that we kind of need and aren't going to stop using and stop going to. So I think that's important. They've managed those assets historically very well through time, and
relatively low debt compared to, let's call them, competitors, right?
Yeah, well, we think of the market, the property market as kind of split in two. You've got the expensive sort of low geared stuff, and you've got the cheap higher geared stuff. And we think about it as a portfolio. We've got Goodman Group on one side as a low geared, more expensive stock, a growth stock, for lack of a better word. Then you've got Charter Hall, which is probably a half growth, half value sort of type idea. That's a bit better value with a little bit more gearing, maybe a fraction more risk than what you've got at Goodman Group. And then Benny, that's going to lead you beautifully into idea number 3, which is
Dexus. So DXS.
Dexus is a value idea. It's cheap, and this is why.
Yeah, so office is quite a polarizing segment of the market. People think working from home is here to stay,
especially when the 3 blokes on the call are all working from home. This is maybe my investment thesis needs to get revisited. But anyway, we'll continue.
perhaps a bit rich, but look, the share price has come down a long way, and too far, we think. So Dexus not only owns a bunch of office properties kind of on their own balance sheet that they've invested in themselves, but they also, like Charter Hall, have a funds management arm, which puts their buildings in funds that are external investors can buy. And they've also got a bit of industrial property in there as well, Dexus. But office is the core for them, and probably why you'd buy into the company.
What kind of office buildings do they own, Benny? Are they on St Kilda Road and in secondary areas, or are they Collins Street, Martin Place type setups?
Yeah, it's your premium stuff. So your Collins Street, Martin Place setups. They've got some pretty high end developments as well. Atlassian in Sydney is one that I've had a look at, just by the leafy green nature on the external is kind of cool if you want to look that up. But in general, really good offices.
Get a little apartment in there, eh, Ben?
Oh, look, if the boss flies me to Sydney, might have to check it out. But
no travel policy in Seneca. If you want to go to Sydney, ride your bike, as far as I'm concerned. Dill, you'd be familiar with in Melbourne, like 80 Collins Street, that development they did there. Pretty high end, flashy thing. Macquarie
beautiful building,
rented out all that. Well, that's Dexus, right? So they're really savvy office developers, and they're pretty good at leasing out buildings, and they get really good tenants and really good long-term leases. And I like this office thematic because on one side you've got everyone saying office is dead, everyone's going to work from home forever. There's a big narrative out there with no data supporting it. And then you go look at Dexus's actual numbers, rent's going up, 95% occupancy. So I love a story where I can see a narrative in the public or in the domain, with other fund managers, investors telling me that office is dead, and then I can show you a hard data example about how it's wrong, and a significant, in this case it's 20 or 30% value discrepancy between the value of those assets and the story attached to them. And that's the price of the share, the price the shares are trading at. So, for
Dexus,
me, it's a beauty.
Dexus have also done a really good job, I think, over the past couple of years. They bought the AMP Capital property funds. AMP were probably the sweethearts 10 years ago of property investing in Australia. They own some pretty big assets.
Assets.
Really good assets. I mean, we really love their infrastructure funds. They hold a large, I think, majority holding in Melbourne Airport, which, Sydney Airport, Auckland Airport, both also listed. Incredible listed airports, but to be able to get exposure to probably the third jewel in that crown through something like Dexus, wonderful. And you're also getting those like One Circular Quay, Martin Place, Collins Street assets that they're just excellent buildings in the part of the city that will forever be the highest in demand.
Correct. So, we a little bit off topic, but we've been investing. We've been shareholders in GQG for a while, and they're a funds management business. They're nothing to do with property, so don't get it twisted. But what we found it's another example of this. There was a narrative in the market around the demise of Magellan, and how the Magellan share price was just in a crater because they lost all their clients. They had negative outflows at month on month, terrible brand association, blah, blah, blah. Really sad story in the way a business can decline. But GQG was actually the same sort of funds management business, getting treated like it was Magellan, yet had positive inflows, best in market inflows month on month. And the stock was trading at $1.50 and $1.40. And, we thought it was worth over $2. Well, sure enough, after 8 or 9 months of us holding that stock and feeling like we were the only people in the country who could, who'd see the value in this thing, it's now trading at $2.10, and every small cap manager in the country owns it. And, so I think Dexus is another example of this. I'm going to be tooting my horn about Dexus in 6 or 12 months' time. I look forward to it. I like telling people that I'm right and they're wrong. It's my favorite thing to do. And just ask Ben. And and I keep my receipts. So I think it's one of the few times that Ben actually agrees with me on Dexus. We both like this stock, and we get paid a nice dividend. What's the dividend yield on that at the moment, Richard?
6% and change.
6% and some change to get paid.
Unfranked.
Yeah, unfranked. 6% per annum. I get paid to sit there and do nothing and own the best quality assets, up and down any business street in the country, and probably pick up 20 to 30% in re-rate when it happens, because this stock historically is traded at 1 times NTA, and it's currently trading at Benny 81.
21% discount.
21% discount, 80 or 79. So cents in the dollar. So I'm going to get that gap back, and I'm going to get paid 6% while I wait. And I've got the best assets in the country backing them. And it's pretty moderately geared as well, old Dexus, given the valuation where it is. So I really like that stock personally. I love having that one in the portfolio. In the interest of time, let's roll faster and quicker through, and maybe a speed round on the next. We got 2 or 3 to go, Ben.
Yeah, 2.
2 more. We've got 2 stocks. I reckon they're pretty easy to explain. And we'll test out young Richo and see what he's got on the speed round. See if we can get through 2 stocks in 10 minutes. Let's go.
All right. So the second area, I guess we've kind of talked about the real estate investment trusts, which is you're essentially investing in the properties themselves. And then the second area we're going to talk about is the technology platforms that sit behind property transactions. I guess the most prominent of those would be realestate.com and Domain, both listed in Australia. But because they're such high quality businesses, like if you're going to list your property, you kind of have to do it on REA, if not both of them. They've got really fat margins, pricing power, and they're valued accordingly. So they're both quite expensive. And so Larry and I, in sweeping the market for value opportunities, have decided that our preferred pick here is PXA, PXA, the code. And that is kind of sits in the property technology stack, but it's on the conveyancing side. So once you transact a property, you have to pay PXA a small fee in terms of their digital conveyancing exchange. So yeah,
I might just chip in there, Benny. So for those people that haven't bought a property, or for those people that have always just handed the paperwork off to their lawyer and hoped for the best, PXA is basically the intermediary between the titles office and your lawyer or your conveyancer if you use one. So what used to happen is that your lawyer would have to walk down to the titles office and stand in a line with a ticket from the, and wait for Mr. Councilman to go to the archives, which are in, basement level 7 of some Queen Street building that no one's ever gone in since PXA came around. Where now PXA digitally facilitates that transaction. So
they do not. So they in Australia they do. Don't quote me. It's 92 or 96% of transactions, property transactions in Australia. So this
they do all the major states except for Tasmania, which is a story for another day.
What's going on the Apple level?
Yeah, well, I mean, I love this place, but there is my horse and cart outside. If he doesn't get a good walk to the titles office every now and then for the lawyers, no, it's just one of those things. There's still parts of Australia that relatively catch up. Hobart has a much smaller property market. The majority of properties transacted on the eastern seaboard, and so PEXA's largest markets down there. It won't. It's pending. PEXA has come out and said we will literally have 100% if we can within a very, very, relatively short time frame. But
it's a monopoly business. It does everywhere except Tasmania currently, and the market is pricing this business fairly for its 100% monopoly, which only leads us to why would we buy the stock then if it's fully valued. Is because the market is completely ignoring the UK business. And Benny and I think that the UK business can be multiples the size of the Australian business. We think they need to win can I say bee's dick on my own podcast? I think I can. They need to win a bee's.
It's our podcast, mate.
They need to win like a really small amount of market share over there to significantly grow their business. Benny, what are we talking about here, market, like dynamics-wise?
Yeah, so market size estimates for Australia is about 280 million. With the UK being 720. So it's about 2.5 times the size in the UK. And the UK is also kind of a bit like Tassie, I think, in that it's a bit behind
paper-based.
If you'll allow me to
slander
the great state.
Yeah.
So, look, there's a bit of growth opportunity there, and it's currently loss-making. So the market's kind of
skeptical.
Negative value of anything, skeptical until proven otherwise, which is fair enough, considering companies traditionally have a mixed track record of expanding overseas, particularly Australian companies. But look, it's a pretty similar legal framework to Australia in general, and we think if they can kind of reverse some of those losses, then between that being valued properly and the high quality Australian business showing through, that it's pretty undervalued.
Benny and I kind of think like at $12, we're underwritten in Australia. Sure, if the UK goes really bad, the shares will go down, like no doubt about it. But from a fair value perspective, an intrinsic value perspective, forget about public markets for a sec. We feel pretty comfortable at $12 buying the Australian company. And then we feel like we get this free optionality on the UK, which we think everyone else is pricing like it's never going to happen. We think it's inevitable that they go digital. We think it's inevitable that PEXA win at least some market share there. And we think it's probably likely that they'll be able to get whatever market share they do get will be profitable and earnings accretive for PXA, given they're already paying the overheads of the business from Australia and a dominant market position here. So, we see that as a natural sort of software kind of rollout strategy. I don't see this. I mean, I look at the examples of Australian companies that have gone overseas. Most of the failures have been built around like store rollouts and physical infrastructure investments in foreign places that haven't resulted in sales. This is just software. You just need a few like boffins and an office. Like we're not talking about huge things that are going to change. And you're riding a structural tailwind of digitization in every asset, in every sector and every place that paper still exists. So I don't see it as risky as everyone else. We think there's a lot of value there. Let's say they won 15, 20% market share. Well, it's going to be high margin incremental profit for that business. And, we can easily kind of get 15, 16, 17 bucks for this stock.
So this thing floated at 17 bucks or so. So just for context.
So we think at 12, we're getting a steal. So that is PXA. Benny, last one, a Luke Laretive special Western Australian led business, one of my favourite companies on the ASX because of its obscene dividend yields and obscene reliability and sustainability of those dividend yields is, drumroll,
Australian Finance Group, AFG.
Love AFG. Love AFG.
So what do they do?
Home state bias.
There's a lot of home state bias. Everyone from Perth thinks only Perth businesses are the way to go, honestly. But, I'm from Melbourne, so I'll give him this one. They're basically sitting on the lending and the financing side. So I suppose this is your other classic way to get exposure, and a lot of people would have exposure to the banks, the big four banks, particularly in Australia, because of their lending to property buyers. But we like little AFG, and it may be little, but it's got a big dividend yield. But they kind of are on the broking side. So they've got an aggregation platform which kind of compares different lending options, as well as the actual lending side. So they're a non-bank, what's called a non-bank lender, of which there's a few options on the ASX. And we have kind of gone through them, and they're, can be mixed quality, but we do like AFG. We've actually spoken to management. We've listened to their risk management principles, and we like them. But in general, the thesis is that they've got these low margin white label home loans that they'll provide, and also the high margin ones which they actually do the lending. So they've got their own warehouses there, and that's quite high margin. So if they own the distribution, the brokers, the aggregation, even though that's low margin, you can push through some higher margin product. And that underpins not only good earnings growth, but on its current valuation, which is pretty undemanding, good dividend yield as well. Dividend yield, it's come down a bit. It was probably 8, 9, 10%. It's probably about 6 now.
Share price going up. It's good. We like share price going up. But yeah,
I was just going to say, I think it's worth noting with an aggregator like AFG, which they are. So they have a network of mortgage brokers. There's thousands of mortgage brokers all around the country. They'll be aggregated or licensed by different people. And talking about low margin, which is an external bank, which is loaned through AFG, as an aggregator, they may take 20, 30% of whatever the broker's fee is. Now, it might not be that much every time. It might be 10%, might be 20%, might be 30%, depending on your volumes as a broker. But if you think that a broker's getting paid generally about 0.7 or 70 basis points on every loan, for every $1 million loan that a broker's out there writing, right, $7,000, how many loans get settled each year? We got the stats on that somewhere.
No, but
well, but it's a relatively small margin, perhaps compared to their own lending, where they're getting a much larger clip on that. But brokers are refinancing and rewriting loans
every day,
every couple of years. It's literally hundreds of thousands of these loans are being financed every single year. So if we take that sort of through and we go, okay, well, if AFG or a similar aggregator are getting 10 or 20% of that every time, that's a fair bit of pretty safe revenue, I would say,
Yeah.
for a business that can generate something that like that as a low margin option.
Mate, I love this business, and you're going to hear me talk about the stocks the same way all the time because it's pretty much how we invest. But the AFG have a great broking business that spits off a shitload of cash every year, flipping brokers' tickets and providing licensee services and other admin services and support. Fantastic, great little business. You know, you wouldn't buy the stock for that business, but your cash flow, your dividend is underwritten by that business. They got into these white label loans where they were doing the some of the origination work, some of the management work, and getting paid a bigger fee by the banks to sell these products under their own label. Now they've been doing that for a while. Now they've got this warehouse facility. They've actually gone out and raised money and said, hey, we're going to lend out to mortgagees, do our own risk assessments, do our own credit risk process. And they're doing that really good processes. Benny and I have been through it pretty closely, and as good, better than the banks, in my opinion, in terms of their assessment criteria, really good discipline around, you know, they could have been trying to really compete with the banks lately or in the last, say, 12 months. And they haven't done that. They've taken the hit on volumes to make sure they keep their credit standards really strong. So I really like that, what the CEO's done there and decided to do. And now we're seeing a more favourable environment for writing loans. And these guys have just got insane leverage to easier lending conditions. So I think, you know, this stock has already started to move, as Ben said, but we think there's significant upside here. Another 70 cents, 80 cents, in my opinion. No problems. It's $1.70, $1.80 a share. And it was $1.30, $1.40, Benny, wasn't it? Not that long ago. And we think it's a $2.50 stock kind of thing. So, you know, it's no shortage of upside here. As we said, you're getting paid really well to hold it. Dividends have grown over time, grows with that sustainable business, naturally growing, you know, more brokers, more loans, bigger lending volumes, you know, every year, and more turnover. Brokers are winning market share off direct lending. So, you know, people don't go to the banks anymore to get a loan. They go to a broker who then goes to the banks. So, and that's been growing, that their share of the market's been growing pretty steadily, and that's the structural tailwind behind this stock. But if they can start to put, you know, as this mortgage cliff happens and people are refinancing more regularly, and, you know, they're doing stuff like debt recycling deal, having a loan with AFG at a competitive price with a 24-hour turnaround and quick approvals and all the stuff that AFG offer that the banks don't, sort of what I'd call the intangibles, but they are very tangible when you're getting a loan. It's going to result in this business earnings just continuing to go up like that. So pretty good stock, I reckon. Pretty good small cap in the small cap fund. It'd be in the large cap fund if it met the criteria of being in the ASX 200, which it is not. But I really like AFG. Have liked it for a long time. I think that's it.
Is that a wrap?
I think that's a wrap.
Yeah. I think I had a bonus pick in there. I just realised.
Ooh, bonus pick.
I might leave that for another day.
Give it to us.
Come on.
You've got
60 seconds.
Yeah,
for a
60-second pitch. Bonus pick.
I'll give you the 60 seconds, and you can read the full write up when we post it on whatever channel it goes on.
Got it. Go.
Right. Ingenia Communities. Code is INA.
I only just got this stock pick recently. I'm annoyed that we're giving this away because I actually only just got in this stock, and I'm all excited about it, and I wasn't going to tell anyone about it. And Ben's whacked it in as the bonus pick, so I'm pretty pissed off about that, to be honest. Anyway,
so this is valuable alpha generation for early podcast subscribers. Anyway, right, Ingenia, they do sort of land leasing for typically retirees. There's a couple of companies out there that do this. Another one that's done quite well over time is Lifestyle Communities, LIC. And, you know, if you're a retiree who's owned your home and you want to free up some equity, you might downsize and live in an Ingenia community with other people in your living situation. And they collect basically a fee, might be weekly, fortnightly, monthly, whatever, rather than owning it outright. So it's a bit of a sort of a recurring revenue model for the operators like Ingenia that do this. And I suppose just to, like, that's got, you know, tailwinds, aging population, people are looking to free up equity. You'd know this better than I would, DPG, but you get the idea. And just the quick spiel of why we think it's potentially going to re-rate is they've got some other assets,
I can't believe I'm going to give this investment thesis away. This is so naughty, but yeah, go on.
Holiday parks, this, that, and the other. They've got a major shareholder who's been very active in M&A and vocal activist trying to spin off assets here. And
who is it? Who is it, Ben? Who is it? Go on.
It's HMC Capital, David DePilla. He basically brokered the Chemist Warehouse reverse merger into Sigma, owned a boatload of shares in Sigma.
Owns a boatload of shares in Ingenia. Ingenia's got an obvious spin-out asset in it. These coastal lifestyle, non-lifestyle community type lifestyle communities. And essentially, we think that, yeah, there's value there. It's beneficiary from bond yields, business going okay, structurally supported. I think it's a good business and it's right, pays decent dividend yield, been growing. But the real upside here is a spin out. If they spin those assets into a new vehicle, we'll get shares in that new vehicle, obviously, as part of the spin out. And as a result, we think there is material re-rate opportunities. If that re-rates to anything that's like a lifestyle communities, LIC multiple, we're going to clean up. So we've only owned that stock for 2 weeks in both funds, 3 weeks maybe, if any. And I'm fucking dirty about this. I'm dirty about this. Yeah, do you know how hard it is to find a stock like that? It's actually that difficult. Anyway, go on.
You better watch yourself, Ben. Bloody,
comes on the pod. I say, come on the pod. Pitch a couple of ideas. Get the people something. We're working on.
Yeah.
He rolls out with that. It's
we're handing ideas out on a silver platter here. It seems like
this is ridiculous, mate. Well, you're lucky it's the 15th, and I've already paid you. All right, that'll do. That's your wrap for the week. We've been through 6 stocks in the property sector. Quick recap: Goodman Group, really high quality industrial business. Charter Hall, bit of both. Dexus, high quality assets trading at a value multiple. We've had PXA, who are going to do a rollout in the UK that we think is going to be successful. AFG, which is a broking business, underwritten by its broking business and got some growth optionality from its lending business, which is higher margin. And Ingenia, which we think is going to spin part of its assets and make us a truckload of cash. Now, I know you can't afford to buy a house, but there are 6 ways to get exposure to the property market on the ASX. Don't pretend like in episode 3, we are not bringing value from Bold Wealth and Seneca Financial Solutions. I'll give you the hot tip. That's hot off the press.
And as always, go and seek advice. Don't buy any of these stocks unless you have researched them yourself and or sought advice from a financial advisor.
General advice warning. General advice warning. General advice warning.
Yeah. Warning, Will Robinson, general advice only. I think we should get a little flash on the screen.
We can do that.
But no, seriously, these are going to be a regular event. I think maybe every couple of months when there's something Ben wants to share, so that Luke doesn't make as much money. No, it's always good to hear. We might do one on just Aussie small caps or something that's not only property focused in the near future.
Sounds good, my friend. Benny, thank you very much for your time and your insights.
Thank you, Ben.
And your betrayal today. And
take the rest of the week off, Ben.
Will do, I reckon. I've earned it.
Yeah, well done, mate. No.
All right. Well, DPG, I will chat to you next week when we do this.
Always a pleasure, mate. Always a pleasure.
Thanks for your time today. Appreciate you dealing with the stock pickers and not your usual wheelhouse. But we're equal opportunity podcast. So
that's right. You got to give the people what they want. And they'll get that next week when we do a podcast about stuff that's actually interesting. No, I'm not joking.
And on that note, we'll see you next week.
Bye.